Having trouble navigating and understanding higher interest rates? Welcome back to John Cairns Realtor Realty Roadmap YouTube channel, where we provide valuable insights on real estate and home ownership. Today we'll cover 9 financial indicators around interest rates in today's market. Let's get started.
Federal Reserve monetary policy. The Federal Reserve, often referred to as the Fed, plays a crucial role in setting short-term interest rates in the United States. When the Fed wants to stimulate economic activity, it may lower the federal funds rate, the rate at which banks lend to each other overnight. This can lead to lower borrowing costs across the economy, including mortgage rates. Inflation. Inflation is the general increase in prices of goods and services over time. When inflation is low, consumers' purchasing power is relatively stable. Central banks aim to keep inflation in check. Lower inflation rates might prompt central banks to lower interest rates to encourage borrowing and spending, thereby stimulating economic growth. Economic growth. Economic growth is often measured by the gross domestic product, GDP, growth rate. During periods of slow economic growth or recession, central banks might lower rates to encourage businesses and consumers to borrow and invest, which can help stimulate economic activity. Unemployment rate. The unemployment rate reflects the percentage of the labor force that is unemployed and actively seeking employment. High unemployment rates can indicate economic weakness. To combat this, central banks may lower rates to encourage borrowing, spending, and job creation. Bond yields. Government bonds are considered safe investments. When demand for bonds rises, their prices increase, leading to lower yields, interest rates. Mortgage rates often move in tandem with long-term government bond yields. If bond yields decrease due to increased demand, mortgage rates might follow suit. Consumer confidence. Consumer confidence reflects consumers' perceptions of current economic conditions and future expectations. When confidence is low, consumers tend to spend less. To boost consumer spending and economic activity, central banks might lower interest rates to make borrowing more attractive. Global economic conditions. The interconnectedness of the global economy means that economic conditions in one country can influence others. If major economies are struggling, central banks around the world might respond by lowering rates to support economic growth. Trade and geopolitical tensions. Uncertainties related to trade negotiations or geopolitical tensions can lead investors to seek safer assets, such as government bonds. This increased demand for bonds can drive down yields, resulting in lower interest rates. Housing market conditions. The housing market's health can affect borrowing demand. During periods of weaker demand for mortgages, lenders might lower rates to entice potential homebuyers. Remember that these indicators don't operate in isolation. Economic conditions are complex and can be influenced by a wide range of factors. Central banks carefully consider these indicators when making interest rate decisions to achieve their goals of price stability and sustainable economic growth.
This concludes our video today. If you found value in this video, please subscribe, smash that like button, hit that notification bell, and comment below if you have any particular subject content that interests you related to real estate. And remember, nothing happens until you leave your comfort zone. Thanks for watching.